Welcome to Commercial Real Estate Now. I'm Carly Iacono. Today we're unpacking the latest jobs report, what it signals for inflation and interest rates, how that shapes the yield curve, and crucially, the implications for commercial real estate. Let's start with the labor market. In August 2025, the U.S. economy added just 22,000 jobs, far below expectations of around 75,000. Unemployment rose to 4.3%, the highest level since 2021. Between April 24 and March 25, the economy actually created 911,000 fewer jobs than originally reported. This is the largest adjustment on record. June now shows a net loss of 13,000 jobs rather than a gain. These revisions underscore that the slowdown is deeper than initially thought. From an investor perspective, this matters because labor market strength is one of the biggest inputs into consumer confidence, and consumer confidence drives retail spending, housing demand, and even office absorption. Now, on the surface, inflation has been easing compared to the 22-23 peaks, giving the Fed some room to maneuver. But tariffs are complicating the picture by driving supply-side inflation. Tariffs rise input costs for manufacturers and consumer goods. Unlike demand-driven inflation, these pressures aren't easily offset by higher interest rates. The Fed's really caught in a wedge. It can cut rates to stimulate growth, but if tariffs keep costs elevated, inflation won't fall quickly. Markets now see a September rate cut is almost certain. Most expect a 25 basis point move, with some speculation about larger cuts down the road. The Fed's challenge is clear. It must ease financial conditions to prevent a labor slowdown from snowballing into recession, while managing sticky supply-side inflation that rate policy alone just can't fix. So what do you do in practice? If you have loans rolling over, refinancing into floating rate paper could generate immediate savings once the Fed cuts. This is also a moment to explore creative hedging. Pairing floating rate debt with interest rate caps or swap options can give downside protection while preserving upside. Laddering maturities is another good option. Mixing some exposure to short-term floating debt with longer-term fixed debt creates a balance between flexibility and security. Smart liability management today can create hidden equity value as markets adjust. Now here's the hidden gem. Rates appear to have peaked with an average 9 basis point decline in the first half of 2025. At the same time, Treasury yields remained elevated. This creates a rare moment. Real estate yields are compressing while financing costs have not fully adjusted. Investors who can deploy equity now and pair it with hedged debt stand to benefit from valuation gains as cap rates grind lower. To wrap up, the U.S. labor market is cooling more sharply than first reported, with historic downward revisions adding weight to the slowdown. Inflation pressures are easing overall, but tariffs are keeping supply-side costs sticky. The Fed is expected to cut rates soon, but its policy path is narrower than ever. For CRE investors, this is a moment to be tactical. Refinance strategically, lean into resilient sectors, and position ahead of cap rate compression. As always, the best returns go to those who read the signals earlier than the market. I'm Carly Iacono. Thank you for joining me on Commercial Real Estate Now.